Are you selling digital products as a content creator? You could owe sales tax in multiple states without even realizing it. Hidden tax obligations can devastate creator businesses. But I'm here to reveal how to navigate this sales tax nightmare and protect your business from costly penalties. Whether you're just starting to sell or running a six-figure online store, this guide applies to you. At Numeratus, we guide content creators through financial compliance complexities. As accounting and consulting experts, we understand this unique challenge creators face and have built proven frameworks to keep your business compliant. Here's the plan. First, I'll explain why sales tax is a hidden trap for creators. Second, I'll cover the biggest mistakes that trigger fines and penalties. Third, I'll show you how to stay compliant before it's too late. By the end, you'll have a clear plan to avoid penalties and protect your business. Step 1. The hidden sales tax trap for creators. Sales tax is a hidden trap that can destroy a creator's finances. Selling digital products, courses, or merchandise online triggers complex tax obligations, and economic nexus laws create tax responsibilities in multiple states. Most creators are completely unaware of these requirements. When you sell to customers across straight lines through platforms like Etsy or Spotify, each state has different rules and thresholds for tax obligations. Digital products, which weren't always taxable, are now taxable. Physical location doesn't matter. Sales location determines your tax obligation. Economic nexus means that if you exceed revenue thresholds in a state, often as low as $100,000 in sales or 200 transactions, you're responsible for collecting sales tax, even if you're not located there. A single sale can trigger automatic tax obligations without your knowledge. I've worked with creators who believed they were fully compliant, only to face audits and fines for selling across state lines. Some discovered obligations years after they should have started complying, with penalties and interests piling up. Online sales automatically cross state lines, and platforms like Etsy, Spotify, or YouTube don't handle state-specific compliance. Digital products are treated differently than physical ones, and rules are constantly changing. What was legal before may not be now. The risks are significant. You could owe back taxes for multiple years, with compounding interest and penalties. States are becoming more aggressive in collecting from online sellers, and audit risks are increasing as tracking technology improves. To stay ahead, use tools like TaxJar or Avalara to check your revenue by state and see if you've hit nexus thresholds, typically $100,000 in sales or 200 transactions. Conduct periodic reviews to spot potential obligations before they become problems. If you're just starting to sell, track sales by state from day one. If you're scaling with a large audience, review the past 12 months to identify states where you might owe tax. Step 2. The biggest compliance mistakes. The first major mistake is failing to register for sales tax in states where you have nexus. Continuing to sell without proper permits is illegal, and each day of noncompliance could add penalties. Registration is required before you can legally collect the tax. The second mistake is assuming digital products aren't taxable. Many digital products are taxable, but rules vary by state, and failing to collect tax at the point of sales creates liability for uncollected taxes plus penalties. The third mistake is ignoring filing deadlines. Missing monthly or quarterly filings, even with no sales, can lead to substantial penalties that compound with interest. The fourth mistake is poor record keeping, not tracking sales by state or product type, or lacking documentation needed for compliance. This makes audits costly and difficult to resolve. Finally, many creators mistakenly assume platforms like Etsy or Spotify handle sales tax compliance. Most platforms only collect taxes in limited cases, leaving you responsible, and their sales data is most often insufficient for tax compliance. The consequences are real. I've seen creators hit with penalties exceeding $30,000 for missing filings, owing back taxes for years with added interest. Some have had business bank accounts frozen during audits, and legal and accounting costs can destroy their profits. States are increasingly aggressive, using technology to identify non-compliant businesses, and creators are often targeted because they are assumed to be non-compliant. An audit can expand to multiple years once issues are found. To avoid these mistakes, map your sales by state to identify obligations. Register for sales tax permits where you exceed thresholds, and collect tax on applicable sales as digital products are taxable. Set calendar reminders for all filing deadlines. It takes just a few hours quarterly to stay compliant. If you're new to selling, start with one state to build compliance habits. If you're a high earner with nationwide sales, audit past sales immediately to catch missed obligations. Step 3. Building your compliance strategy to stay compliant. Adopt a proactive approach before states catch up with you. Audits are becoming more common for online sellers, and states can demand years of back taxes, penalties, and interest. I've worked with clients who've been blindsided by audits because they lacked organized records. Many creators think, I've got time, my sales aren't that big, or states won't bother me because I'm a small creator. This is a dangerous way of thinking. In 2025, states are targeting creators of all sizes using technology to identify non-compliant sellers. Small creators are often easy targets than large corporations. Your compliance system should include 4 components. First, track sales by state using a sales tool to monitor when you're approaching nexus threshold. This provides alerts before new obligations arise and maintains detailed records for audit protection. Second, set up automated tax collection to apply corrected rates for each state and product type, reducing manual error that triggers audits. Third, manage filings by submitting returns on time, even with no sales, and keep digital backups of filings and payments for audit perfection. Set calendar reminders for all deadlines. Fourth, consider working with a sales tax specialist to navigate complex multi-state nexuses. Professional guidance can save money and reduce risk. This proactive approach has saved dozens of our clients from sales tax nightmares, preventing penalties and audit selection while providing peace of mind to focus on growing their businesses. Compliance is much easier to maintain than fixing problems later. If you think this sounds like a lot of work, it's not as tough as it seems when broken into steps. Spending just 1 hour monthly organizing records can prevent the stress and financial disaster of fines and audits. Ready to navigate the sales tax nightmare and protect your creator business? Whether you're facing sales tax or other financial challenges, book a free strategy call with Numeratus using the link below. We've helped dozens of clients stay compliant and keep more of their earnings by customizing roadmaps for their specific situations. Subscribe for more creator-specific strategies and compliance updates, and join the Numeratus community for ongoing support and updates on sales tax and financial planning. Don't wait until state audits or penalty notices hit. Proactive compliance is far easier than reactive crisis management. Schedule your consultation now to secure your financial future. Our next video will cover more insider tips for creating financial success. Sales tax obligations are real and growing for online creators, especially for digital products. States are actively targeting online sellers, and prevention is infinitely easier than dealing with audits and penalties. This applies to all creators. I'm urgent about compliance, but optimistic about solutions. Compliance doesn't have to be overwhelming. It's essential for your business's success and its growth.